Mike Falk walks into a bank. His head is held high. He knows that this bank is going to be able to give him a loan. And so why is the bank able to do that?
Hello, and welcome to this episode of Let Me Ask You This, brought to you by the California Association of Realtors. My name is Matt Roberts. I'm the CAR Federal and Local Government Affairs Director. Joining me, as always, is my colleague, Mike Falk, CAR's public policy economist. And Mike, this episode, we want to continue in the mini-series we're doing on Fannie Mae and Freddie Mac.
Yep.
What they do, why they're important, why we need them for Mike Falk to be able to get a loan
For a functioning mortgage market.
Yeah. For a functioning mortgage market. The first episode, we talked about the benefit that Fannie and Freddie do very broadly to the consumer. Mike Falk can walk into any bank. As long as you're qualified, you get a mortgage.
Right.
This episode, we want to really kind of deep dive a little bit.
Open the hood, yeah.
Open the hood, well put. And figure out, okay, how is it that Fannie and Freddie do what they do, right?
Right. Yeah,
so
I mean,
walk us through. Yeah.
You teed it up nicely. So, I walk into, or Mike Falk, the fictional character of me, walks into a bank to get a loan, and, the bank person, teller, whatever, says, we can do that. And the reason they can do that is because Fannie and Freddie are buying all these loans from the bank. So we kind of talked about that before, but now we're going to take the next step.
Yeah. So what do they do with them once they buy the loans, right?
Right. So they have all these loans, and then they package them and they sell them to someone on Wall Street.
Okay. So, all right. So bank makes a loan to Mike. It takes your loan, puts it together with, say, 99 other loans, goes to Fannie and Freddie and says, okay, Fannie and Freddie, I got these loans. They meet all your requirements. And Fannie and Freddie says, yes, we'll buy those loans. Fannie Freddie's got the loans. They go to Wall Street. Wall Street says, yes. As a matter of fact, we're happy to buy Fannie and Freddie package mortgage-backed securities, MBS. Yeah. Why are they willing to buy them?
Yeah, I mean, so when they go and they say, hey, Mr. Wall Street guy, here it is. And the reason Mr. Wall Street guy is excited about it, well, there's actually a couple of reasons, but it's a great investment.
Let's keep it simple. Keep it simple.
So from a Wall Street perspective, this is a great investment. And the reason for that is that Fannie and Freddie take on the credit risk.
Okay. Now, to be, again, keeping it simple, there's really two risks that the investors of these securities are looking at or could be looking at. One is credit risk. The other is interest rate risk. Mm-hmm. But, with a mortgage-backed security backed by Fannie and Freddie, there is no credit risk. Fannie and Freddie basically say that if Mike Falk defaults on this loan, mm-hmm. they will make the investor whole. The investor will not lose money by any defaults or foreclosures on the loan. So there's no credit risk with Fannie Freddie mortgage-backed securities.
Right. Now, if I'm an investor, that means a lot to me.
Yeah.
I mean, that means a lot,
Yeah. I mean, you're willing to accept a lower return than perhaps if you were taking on both the credit and interest rate risk. And the interest rate risk being... Explain the interest rate risk.
Well, Matt, you may have noticed that sometimes mortgage rates are up, sometimes mortgage rates are down. It changes every day. And if you're taking on these loans, these are 30-year fixed rate mortgages. I mean, not all of them are going to go 30 years, but, some of them are going to go for a while. And if the interest rate, you bought them at 3 and then the interest rate goes up to 6, maybe you wouldn't be making as much money as you were before, but you still don't have to worry about that credit risk. So you are only interested in that interest rate risk.
Okay, so the only risk is locking up your capital for a long term, perhaps at a lower rate than what you may be able to get in the future.
That's right. Yeah.
Okay. And for their services, Fannie and Freddie, how are they doing it? How are they keeping the lights on and paying the bills?
Well, I like the lights on analogy because that's all they want to do. I mean, they're not, going out and buying Fannie and Freddie yachts with all this stuff. They want to just keep the lights on, and the way that they do that is they charge a fee either on the interest rate or on the loan itself, because they are taking on that credit risk. I mean, they need to, have something, but that's
Right.
it.
Right. So the buyers are the buyers are either paying an upfront fee and or have a small fee added to the interest rate. And to be clear, we need to get a little bit more detailed on what the fee is being used for. Obviously, keeping the lights on, but Fannie and Freddie are building their reserves,
right?
Which is really important because behind Fannie and Freddie is the U.S. government, guaranteeing that if Fannie and Freddie were to go into financial problems, investors in mortgage-backed securities of Fannie and Freddie, they know they're not going to lose money because if Fannie and Freddie are unable to pay, the government will step in and make the investors whole.
Right. Those reserves are so important for that reason.
Yeah. And so to their credit, the regulator of Fannie and Freddie, the FHFA, I don't want to go too deep down this hole, but I think it's important I think it's important for people to understand they're building their reserves. The fees clearly match, perhaps in some cases are a little too high, but they do definitely cover the costs and risks of the loan.
Right. They're just a step below, the U.S. Treasury, which is still, for how long, considered, the gold standard safe investment that, actually in the entire globe.
For now.
That's true. I mean,
yeah. That tees up the next episode, which is going to be, let's dig into the government guarantee.
Right.
But we'll save that for the next episode. Maybe we just kind of take that last holistic approach, look at, where we are as far as understanding the role of Fannie and Freddie.
Sure.
So Mike Falk walks into a bank.
His head is held high. He knows that this bank is going to be able to give him a loan. And so why is the bank able to do that?
Well, and the bank's able to do that because the bank knows that they're going to be able to sell it to Fannie and Freddie, who's going to buy not just your loan, but about 99 other loans and package it together.
Right. And then, they're going to take that package. They're going to go to Wall Street, say, here's what it looks like. What do you think?
And Wall Street's happy to take a look at that and say, well, we love it because we don't have to take on any credit risk. Fannie and Freddie, you're going to take the credit risk. We'll take the interest rate risk.
Mm-hmm. And we'll pay that fee and, keep her moving.
And then the next Mike Falk can come along and the bank is always going to have that money to invest, to make a loan.
Yeah. Mike Falk Jr., Michelle Falk, whoever it's going to be.
There you go. Well, thank you everyone for joining us as we continue our journey through the world of Fannie and Freddie.
Yep.
Deanne, hope you enjoyed this as much as we enjoyed putting it together. Good luck editing it. And we'll see you on the next episode of Fannie Freddie mini series. Thank you for joining.
Thank you.